We have Gabriel Wallach, who's the head of global emerging markets at Fortis Investments, and Gabriel manages about $2.5 billion in assets, and he joins us this morning on the program. Gabriel, you are a big bull on emerging markets. I think back in January, you said that we could see corporate profit growth in these markets of 40%, which pretty much will translate to the stock markets. So 40% gains for the equities as well. Do you still stand by that?
Yes, we maintain that view that earnings growth will be approximately 30 to 40% in 2010 for the MSCI Emerging Markets Index. Without much multiple expansion, and markets are trading at around 12, 13 times earnings, we should by year end see those types of returns. The drag this year has been Asia, particularly China, on fears of tightening property measures, and Asia has had a bit of a negative return, while some markets in Latin America are breaking out to 52-week highs. Emerging Europe as well. Russia has been very strong. So really for the MSCI Emerging Index to break out to new highs, you need China and Asia to participate.
Yeah, but as Paul pointed out, a lot of these technical indicators are saying close your current position, maybe take your profits and run. I think people are seeing monetary tightening on the horizon, and obviously it's scaring off investors in developed markets. Why not in emerging ones?
Yeah, because we continue to see a cyclical pickup, both in developed and emerging, which is driving growth in sectors like materials, energy, consumer discretionary, technology. Ironically, the driver of that growth has been China, and that's the market that's lagging. So that's why I say that China needs to catch up to the rest of emerging, and it will not do so until investors feel comfortable with monetary policy, as you mentioned.
Yeah, so what's your advice in investing in China then if it's been a laggard play? Do you go in and hope that the gains will catch up, or do you just close out and just cut your losses?
Well, we remain overweight. Of the four markets that we like, Indonesia, Russia, Brazil, and China has been the laggard. We continue to remain overweight. Now, within China, what has worked are consumer stocks, consumer staples, internet. It's been dragged down a little bit by financials. So again, for financials to work, for China to work, you need investors to feel comfortable about a monetary policy.
Gabriel, since you mentioned you like the internet, do you like Baidu at the moment? Would you buy Baidu, take advantage of Google's problems?
Well, we can't really comment on specific stocks. We don't own Baidu currently in the fund, but we're actually very much overweight the internet space in China.
And that's you see the ad revenue coming through, because the concern over the internet in China is always the censorship issue, and the government says, we don't like that site, close it down now.
Yeah, I actually think the advertising growth in the internet space, with or without Google, was actually seeing a nice recovery anyway. Year-on-year comparisons were very easy, and you are seeing a cycle in that space. So yes, I would be adding to internet stocks at this point.
Yeah, isn't that a pretty crowded play? Because again, consumer, internet, you keep hearing these sectors talking to investors in the Chinese market. If everyone piles in, that's why you see these valuations really get out of reach, and PEs at huge multiples.
Yes, but I mean, that's where the growth is. That's where the pricing power is. People are concerned about inflation, but ad rates are rising. In consumer staples, you're seeing companies raise prices in food products, beer, et cetera. And so that's where the growth in China will be.
Yeah, let me just ask you also about your other country weightings. You have an overweight on China, Brazil, Russia, Egypt. I want to pick up on Egypt because yesterday we had Morgan Stanley actually downgrading this market to underweight, saying that there's a lot of caution in this particular field.
Yes. Well, besides the downgrade, there was some negative political news on the health of the president, but it has been one of our small overweights through the financial sector. Very nice growth that we're seeing there, a recovery in the economy. Political concerns, elections would damage some of the upside, but it's been one of our best performing markets this year.
Yeah, okay, but of course Morgan Stanley continues its overweight on the BRIC countries. Yes. But amongst your overweights, I don't see India amongst the group. Why
is that? That's correct. India's our only underweight in the BRIC markets. It is one of the most expensive markets in emerging at around 16, 17 times, and we are not, the GDP growth that people are expecting is not translating to necessarily earnings growth across the entire market. And another market where people are very concerned about tightening.
So what do you want to see change in India? How are they going to get back on track? What would bring you in?
Well, earnings growth has to pick up across different sectors. Valuations are obviously already pricing in that 8-9% growth that India is promising. So in a sense, it's a market that's already priced in its actually fantastic growth, whereas the more cyclical markets exposed to commodities like Brazil, Indonesia, are still very attractive.
And then you know what I find interesting also amongst your picks is Thailand is in the mix as well, especially with these protests that are taking place in the Thai capital, Bangkok. Aren't they threatening to douse gallons of blood today on government buildings? I mean, that's got to get to investors a little shaky.
Yes, I mean, we entered the market during one of the downturns where people were concerned about the political events unfolding there. It is one position in that market that is exposed to not just Thailand, but also Indonesia and China. So it's a good company that happens to be based in Thailand. We're not necessarily recommending investment on the domestic side of that market, given the concerns.
And Petrobras also involved?
Yeah, also. I mean, a commodity play, Petrobras, so straightforward one.
Well, it's been a laggard because they need to raise somewhere between 40, actually this morning in Bloomberg it was 60
Huge,
billion.
$60 billion in the share offering.
This is a company that's going to expand aggressively in exploration in Brazil, needs the money, quite a bit of money, and will raise it through an equity offering. The government would fund about half of that. Yeah,
but highly politicized. I mean, the government seems to want to take control of it, doesn't it? And its oil reserves.
That's not the view we have. I think the government has always been proactive in creating value for shareholders, including themselves, by spending the appropriate amount for exploration, for growing the company, growing earnings. So it's less of a political concern than the capital raising issue, which is a headwind or certainly an overhang on the company.
Gabriel, I'll just ask briefly, we've been doing some stories lately about the fact that US mutual funds are running out of cash. Basically, new cash isn't coming in, and they've spent everything they've got on the markets. Are you finding that with emerging market funds at all? Are you getting cash in?
Cash inflows are pretty strong this year. They were 81 billion last year. Year to date, I believe it's running around 5 or 6 billion. And I think that will continue. As I mentioned earlier, the valuations are relatively attractive versus the growth rate, certainly, and that will continue to cause investors to shift into emerging from possibly developed.
Okay, Gabriel, thank you for dropping by on this Tuesday. And thank you, Paul, for helping out here. That's Gabriel Wallach, head of Global Emerging Markets at Fortis.